Hi, welcome to this special episode of Insurance VC, PE, and MA. And today we got a very special guest for you. And we have Colby Allen and Mike Mensch from Agency Brokerage. Welcome to the show, guys. And today I get to interview both of you guys, and that's going to be exciting. So we want to make sure that we take turns, and I want our audience to get the knowledge from both of y'all because knowledge, opinions is everything. So if we can, let's do a little introduction real quick. Colby, you can go first, and then Mike go next. How'd you guys get into the world of insurance? How'd you guys get into the world of M&A? How'd you guys get into agency brokerage? So if you guys can give us a little intro background and before we start the show.
Sure. I'll be the consistent person that says when they fell into insurance, right? It wasn't on purpose. I really went to a college career fair and the local insurance program professor said, I have a 100% career rate before graduation, which is the best thing you could tell a college student, right? You're going to give me a job. So I stumbled into an internship in the finance department at a regional agency at that time. And that just accelerated a career into the corporate finance and reporting FP&A side of a big agency. And part of that process was being on the M&A team as we would acquire agencies, books of business, help with the due diligence process, look at the carrier listings, and then also the reconciliations after the fact. So you can say not exactly from day one, but very early, my career in insurance was an accident. But 12, almost 13 years later, it's been a great ride. Spent 8 years at that agency, through a couple of changes, worked at a carrier for 2 years on special projects and then shifted into consulting and financial and M&A, and most recently joined Mike Mensch and the ABC team to help expand consulting fee-based services with our brokerage services. So I'll pass the mic.
I'm second generation in the M&A space. My mom was in it and I followed her. I got into mergers and acquisitions probably around 2006 and started working with agencies 2008. The big wave that we had was in the state of Florida nationwide. That was the first place that they cut all their captive agents loose. So we had a lot of activity of these guys that were close to retirement age and ladies that were in the captive world most of their career, and then went independent and then decided, okay, this is too much. And they threw their hands up and wanted to exit. So we did a lot of M&A in the state of Florida for a couple of years. And then we expanded outwards over the last, 16, 17 years. As a firm, we've done about 500 M&A transactions. We've evaluated a couple thousand independent agencies. We got clients from I think we just closed one in Seattle, so all the way up in the other corner of the country. We're based out of Florida, but I've been doing it a long time and seen a lot of different things. And I do have insurance licenses too, but I don't claim to be an agent by any means.
On the subject of Florida, as we recording this episode, October 8th, 3:42 p.m., we just want to make sure that we say a quick prayer for all the folks in Florida. I mean, they have Hurricane Milton coming their way tomorrow, and they just experienced Hurricane Helene, and there's one more coming next Thursday, which is just absolutely insane to me. So, Mike, you probably have a lot of customers in Florida. Have you been talking to them lately? Friends and customers, right? Because you live in Florida, don't you?
The eye of the storm's coming over where we live. So yeah, we're in
Wow.
Florida. But we've got clients. I've got family over in the Tampa Bay area, and they're still cleaning up. They're still cleaning up after Helene, as you know. And so this is going to be quite devastating, I think, to that area. But I'm on the other side of the state. The storm's going to enter in Tampa and exit over in Brevard County, which is where we're located.
Has there been a time that you've seen this many storms back to back at this size?
I mean, I've been here since 1988. We had a couple in 2004, 2005 that did a lot of damage. I think those were all Cat 3s, maybe Cat 4. These are pretty significant storms,
Yeah.
obviously.
So, Mike, Kobe won, and your turn. Can you give us the beginning phase of when you build your company, and then I'm gonna take you guys through some questions about how you guys do your business models, but give us a backstory.
Sure. So I jumped into the M&A world at probably the worst time you could, which is right after the financial meltdown. So you know, financial markets melted down, lending dried up, but independent agencies have intrinsic value, and so that's kind of the reason we stumbled into it. We had a client that had a distribution company, had a brother that owned an agency. We put it on the market. We had multiple buyers bidding on it, and we found a lending source, which was unusual back in 2007, 2008. So it was kind of an opportunity. There weren't a whole lot of specialists in the insurance industry back then. And we started in the state of Florida, expanded outwards, and with the internet, of over the years done a lot of webinars, done a lot of articles and everything. So we just ended up building a national brand. I think from a transaction volume perspective, we're number 3 in the country. And every year we do more and more. We get, our pipeline of business increases every year just because we've been around longer. So our process is we want to get in front of owners, help them understand the value of their agency, work with them over a period of time until they're ready to exit, but really trying to give them some value added information and guidance on things that they can do. So like we've got clients that I've been talking to for 15 years, 10 years, whatever. So obviously the longer you stay in business, the more relationships you build like that. So we keep expanding, and we're growing every year. So Colby joined so that we can offer additional services, which he can talk about too. But we're primarily an M&A firm. We do a lot of valuations. Now we're kind of getting a little bit more into the weeds with agencies, helping them solve some of the problems that we really think inhibit their ability to increase their equity value.
So let's go into that a little bit. And
Sure.
I'm going to play some scenario games, and our audience probably thinking those way. So hopefully I hit them on the dot. What does that process look like if I am thinking I'm 2 years out trying to sell? When do I start preparing?
Colby, you want to chime in?
Yesterday is when you should have started preparing, but there's no better time than today, especially if you've got a good window before you can really plan your exit. I think that's one of the biggest differentiators, is an owner who's actively engaged in planning that process versus making assumptions, thinking that you can experience some type of exit based off other people's stories. And so, yeah, if you said you're 2 years out, that's a good window for engaging with someone like us. We can start a valuation process to kind of get in and learn who you are as an owner, learn about your company, provide a fair market valuation to assess where you currently stand, and then find or uncover some things maybe there that you might be able to improve or want to optimize within that time window, and make an informed decision, right? Is now the good time to exit, or maybe do you want to take some time to work on a few things?
If I can chime in on that. So I just dropped a 2-week daily series of posts on LinkedIn around the topic of building long-term value in an agency. And it was really, I dissected a presentation that I gave to the PIA, kind of just every day dropping a little bit of information about here are the principles of what you need to run your business by. Here are the components of the agency that you have to work on. And at the end of it, I went into 4 different, what we call 4 common issues that we run into in agencies. And there are 4 issues that inhibit the owner's ability to increase the value and a lot of times grow. And one of those is owner dependence, which is the agency is too dependent on the owner. They're either the key producer in the business, or they just have 100% control and 100% responsibility for everything in the business. The second one we touch on is lack of growth. So the agency doesn't really have a good marketing strategy, and sure, in this market, everybody's revenues are going up, but are they really adding customers? So that, if they don't have a strategy for growing their business, then that's when you see a lot of them just flatline or start to decrease over time. The third issue we run into is poor sales management, meaning either the AMS isn't set up where the procedures are being followed, so that data is being entered incorrectly, so you can't really get a good snapshot of your book of business, or the producer relationships in the agency are all different commission splits, different terms of the agreement, or there's no agreement. And then the third sales issue is that just what we call the shotgun approach, where the sales staff are just placing business wherever they can write it, whoever's pricing the lowest. And then what that does, it just gives you a big carrier spread. So you don't have concentration of revenue with carriers, which leads to lower profitability and a lot more management headaches. So, I say all that because the earlier somebody starts to think about that, think about how do I fix the issues? How do I put a strategy for growth? All those things drive long-term growth in the business. That way you have a business that when you're ready to exit, you've increased the value, you've set up the systems and everything that's going to get you the maximum value. And then your transition is going to be a lot smoother because you're not the key producer, or you don't have to get through all these challenges and stay on with a buyer for a number of years to get through all these obstacles to transition the business. So the sooner the better. Like I said, we've got clients we've been communicating with for 10 plus years, and maybe we do evaluation. We look at things every couple of years, but it's the exit is why a lot of people get into owning a business. They want to build something for retirement. So the earlier you start to think about what that looks like and how you can maximize your exit, the better that position you're going to be in down the road.
Okay. I feel like there's a separate episode that you and I can create literally on your 11-part episode. Like instead of putting that on LinkedIn, we can put it in video content and it would really flow, right? But let's come back to by the way, you know what? I am gonna talk to you about that. So audience, if you're listening to it, pay attention because we might drop another episode with Mike. But let's come back to what you guys used to see. Tell me some of the top mistake you hear people say to you when they approach you from day one. Like, what are some of the common misconceptions that people have about selling their agencies and how to do the valuation, stuff like that? Thank you for watching this video. Now a quick message from our sponsor, MAV.
Thanks, Jeff. I want to let you all in on a secret that top producing agencies don't want you to know about. If you're in P&C insurance, you know firsthand how much you're getting squeezed by your call center. It's becoming less predictable and less economically profitable to scale. But here's the thing. The top producing agencies making over $100 million are not running their leads through a human-based call center. They're running them through an AI expert like MAV to qualify, quote, and hand deliver the highest intent qualified leads to your agents. MAV takes care of the back and forth, having unlimited 24/7 conversations with your leads that are personal and relevant so you can scale to the moon. Ready to ditch your call center and 10x your agency? We're giving the listeners of InsureTech's $15,000 worth of credit to try MAV. Head to hiremav.com/InsureTechs to claim this offer.
I mean, this has been a persistent problem for a long time, but in my experience, I think what is changing is there was either a generation or wave of owners that, you're so focused on running your own agency that to think outside of what you're doing isn't always an open thought. And so what has emerged in the most recent years is a lot of either mastermind groups or networking groups where owners are a lot more either open or transparent as to how they're managing their agency, their people, their processes, to learn from one another, because it's not uncommon. So back to your question, right? What's the big mistake? It happens. Someone is so focused on what they're doing and in kind of their own bubble or maybe their blinders that they've performed really well. They feel like they've done a really good job. And then when you actually get to an assessment, there's a lot of either risk factors or other hurdles that can get uncovered that they might not have even been considering. So it's kind of like to the 4 pillars that Mike was talking about. If you're wearing the CEO, the CFO, if you're wearing every single hat in the agency, it's really hard to see all the different risk areas that you may need to pay attention to. And so someone so focused on what they're doing, you can get to a certain point of growth or profitability or even productivity. But taking a step outside of that and thinking not just in your own personal benefit, but how do you build a system, like just what Mike said, to be able to sustain itself less dependent upon you is a big, big thing. And so a lot of people, I think, do really well in growing to a certain point. But a big hurdle sometimes is maybe their own self or their own pride, instead of thinking about, okay, well, how to look at the business other than just my contributions.
From a transactional point of view, meaning somebody comes to the point they're ready to sell, issues that they don't anticipate are tax consequences, You know, we had a client we have clients that are C corporations and they don't realize that that's going to create a double tax upon a sale. We have clients who don't have good agreements with producers or key people in place, and so that has to be addressed before sale happens. So there are planning things and you know, tax planning, legal issues that need to get resolved, or sometimes they're part of a network and there's a network process for exiting a different network, or a fee that goes along with exiting networks. So there are things that, from a transaction point of view, that can be addressed if you get in front of them early enough as well, not just the things you should be doing to maximize the value along the way, but, you know, prepare for an exit transaction itself.
I'd say a common example of that, Mike said
Oh,
about contracts.
Jeff was muted. He was trying to talk.
No, go ahead. Keep on going, Colby.
A lot of agencies like to offer producer equity or producer some type of compensation plan in their book without really thinking of the long-term implications. And so you can put in some type of producer vesting program, but unless you try to plan the impacts of that when you actually close on a transaction, or even a deferred liability standpoint, a lot of owners don't think about those things, right? It's meant to be an enticement or an incentive to attract good talent. But unless it's planned well, it could definitely cost you or have other downstream implications that may have been unforeseen.
Yeah. So when I come to you first day, do you guys have checklists of every single offering that you do? Because I would think it'd be like a option box, or it's just like one size fits all. Because when I think like valuation, is there more to it? Let's say, okay, Jeff, we're gonna value a company, but are we gonna help you, consult with you to prepare you for the sale? Are we gonna help you, consult with you, pick investment bankers to represent the company, or do you guys represent them as well? So can you go a little bit into that one?
Yeah, so our main line of service we are a sell side M&A advisor. So we're in the investment
Okay.
banking function. But yeah, I mean, for years we've done valuations for clients. We tell them, okay, here's your value, here's some issues. You need to go fix them. We'll talk to you in a couple of years and see how you did. And what you find out is, like any type of consulting, unless somebody gets in there and kind of holds the owner's hand to make the fixes, they don't get done. It just business as usual going forward. We look at it again a couple of years later and the same issues are still there. So Colby is come on board because he's got experience in finance and fractional CFO. So we're rolling out the fractional CFO service where he's going to work with the owner on a monthly basis, you know, with clients that want to go down this service, work with them on a monthly basis, get their financials in order, set goals, set KPIs, and kind of get them tracking towards different goals to help move them along in that process of making changes to make improvements. We're rolling out some other services. We're trying to finish up what we're going to call continuity planning, which is, we have so many agencies we talk to that are single owner, and the biggest fear is, what happens if I get hit by a bus tomorrow? And that's a legitimate fear. If you're the key producer, or, you know, 100% control lies in your seat. So we are putting together a service where we're going to help them get everything organized, have a game plan, you know, put a document in place that says, here's exactly what's going to happen if you get hit by a bus, or, you know, you become disabled and there's, and you can no longer run the business. We've got everything organized that somebody needs to step in and take over, and we have a game plan worked out already. This is what's going to happen. And we ran into this because a friend and an agency owner that we know died unexpectedly in January. And so I was already thinking about this idea for a couple of years, and having to work with his financial advisor and his spouse through this process really kind of put an urgency on it. Because, you know, nobody, if in that instance, you know, the family around the principal that passes away, they're dealing with so much already. The staff are dealing with so much. And so if there's no plan in place, then, you know, just putting a lot more burden on everybody. So our objective is to have a service where we're going to help them get organized, put the game plan together, and then it's just, you know, every year we update everything. So that way going forward, it's kind of like an insurance policy of what happens with the business if something happens to you. So that's one of the services we're putting out to kind of fix that owner dependence issue, or at least to mitigate the risk of the agency being so dependent on one person. And then we're also working out, we're doing some succession planning services and other things. So We've primarily been a valuation M&A advisor. We've decided we want to get more in the weeds with helping people with a lot more issues than that. And that's the things that we've been working on over the last year or so.
Got it. So more questions, right? Like every time you give us a little bit, we got like 30 questions. Well, I got 30 questions. What about the people who want to buy? Let's just say I am a $2 million revenue agency and I want to grow, right? But how hard, like we know it's hard to go buy agency, the right agency. And nowadays, like maybe even for the past 10 years, all these agents, mom and pop size agency from 3 to 20 employees, they're competing with Acrisure and all these PE backed, gigantic operations who have tons of MA team, right?
Yeah.
So if I am some guy, I don't know, in Tampa, Florida, and I want to grow my agency and I reach out to you guys, say, help me. Is there something that you guys can do to facilitate when?
So our main focus is helping the owners that are wanting to sell their agency, but we provide transaction support because we wouldn't make money if we just jumped at everybody that's looking to buy an agency and said, look, I want to look in Tampa. I want to look at it. It's too much trying to match people up like that. But from the buyer's point of view, one is, we've got a newsletter that goes out that says, here are the opportunities we're working on. If somebody's interested, they can inquire with us. Two is if somebody's working on a deal and let's say they've never done an acquisition before, they really should get professional support through that process. So we offer a transaction support service where we'll help them with due diligence. We'll help them identify issues and talk them through the things that they probably need to look at. They may not have otherwise. Like I met with an owner a couple of years ago that had bought an agency and all he got was tax returns. And after the deal, he didn't realize like 25% of the business was commercial lines and he thought it was all personal. He didn't know anything because he'd never done an acquisition like that before. His bank approved it off of the tax returns and he thought, okay, good. And so if you've never, if you're going to go spend $1 million, $2 million or whatever it is, and you don't have a lot of experience on an acquisition, you should definitely spend, $5, $10, $15,000 to get the right advisory services through that. So we offer that kind of due diligence, transaction support.
So are we at an era where there's no turning back as the big gets bigger?
The big have gotten much bigger. The independent agency pool, they try to do these studies to figure out how many independent agencies are out there, and it's not an exact count, but I think the number hasn't really effectively changed in 20 or 30 years. And the funny thing was there was a book in 1978, which was the year I was born, by Russell Miller, who was like the original M&A guy in the industry. And he said, the industry is going to shrink because all this M&A activity that was happening in the 70s. And that never actually happened because, these companies go do roll-ups and then the producers leave, they're unhappy, they leave. The principal works through their earn out and they go start another firm and grow again. And so there's always this like a wildfire going through all this M&A activity. And then next thing you know, there's new agencies sprouting up and because people just, have that desire to go out and start their own business and everything. So it's not dwindling the agency pool. It definitely has concentrated a lot more revenue in the industry, but you're always going to have that entrepreneurial spirit that people are going to go out, start their own firm and try to compete.
There's also, the estimate number is like 40,000 roughly. It hovers between 38 and 40 each year. But the average size of the independent agency across the country is close to 750 in revenue, right? So it's not I think it's about 750 in revenue, total average, right? So that's
Big
not everyone you see is going to be the big, $100 million shop that's just write a check for every agency they want to buy. And also, if you look at the Insurance Journal or Business Insurance, like top 100 list of the agencies, there still are plenty in that list that are still solely privately owned family agencies or multi-partner agencies that may not be backed by PE funds or larger buyers. And so there is, like Mike said, that entrepreneurial spirit, even at scale, but there still are plenty small or middle market family owned agencies across the country.
I got some questions now. More questions. Your 500 transaction plus that you have done, right? What percentage of them is from the personal and commercial line type of agents, and what percentage of those are from benefits? What would you say the mix will be?
At least 90% PNC.
Okay.
At least 90%. Predominantly, our clients are in the PNC space. We work with some benefits. We work with some Medicare agencies and FMOs, but our main clients are in the PNC space.
And then your top 5 states where your agents are from?
Follows the population: Florida, Texas, California. It generally follows the population.
What's the market view today on Florida, Texas, California with so much change of carriers and lowering commissions? And how do you see the market view on those?
We had, when Hurricane Ian rolled through a couple years ago, and that was a big one that hit Florida. That was right at the beginning of when the personal lines started taking some significant losses, and the combined ratios went up. And so the last year, unfortunately, we were getting to a point where it seemed like the carriers were coming back to profitability and it was going to look nicer. And now we're getting some more of these hurricanes. But for the last 2 years, there has been a bit of a pullback on some of the larger aggregators on acquiring personal lines focused agencies. They were looking for at least a blend of 50-50 commercial personal lines, but there definitely was a pullback because of the concerns about what's happening in the personal lines market, and particularly states like California and Florida, where you've got significant losses by these primarily domestic carriers or carriers that are pulling out of the states.
So go ahead, Mike. Colby, go ahead.
No, I can add a comment too. You mentioned about cutting commissions. I think as a CFO or a fractional consultant, I have seen, I'm not going to discount or discredit that some carriers are shifting their commission schedules. But one thing I think some agencies don't really consider is the current market conditions. It's very rare that I've seen a carrier just cut a current agency's commission with an active book. In more cases, it's actually them implementing probably a tiered commission schedule based on the agency size. So the intention is to grow to a certain scale. But what some agencies don't consider is right now with the rate environment, even 1 or 2 points change in a commission rate on a book of business, if that carrier is taking 10, 15, 20, sometimes 20+% in rate, there are actually agencies that if the setup is, the way it's aligned, actually losing policies, losing clients, but increasing in revenue because the lost clients or policies in force decreasing is actually offset by the rate increases. There's a certain AMS vendor that has a report that you can actually see the analytics of policies in force, customers in force, and premium in force. It's not uncommon. The last 2 years, you can see the customers and policies go down if the agency doesn't have a good retention strategy, but the premium still goes up, right? Mm-hmm. So it's the combination of looking at those different KPIs and how they play with one another. It is easy to talk like, oh, they're cutting commissions, we're going to lose money. But actually, contrary to popular thought, I haven't seen that happen as drastically as some people probably claim, because it's, again, the combination of the rate increase with those different changes.
Yeah, I would say in the state of Florida in particular, like 2 years ago, a number of the carriers cut commissions. And yeah, it immediately you see a revenue reduction, but 2 years later, the revenues are up because the premiums have gone up enough to offset it.
Okay. Now I'm getting to a little bit harder questions. When you're advising your clients, right, about how they want to approach a sale, how they want to approach an exit, what are some of these conversations like when they have choosing between multiple offers and the offers are surrounded around cash versus stocks, earnouts in years, right? And also there's some of the buyout that they withhold, right? Let's say they do $10 million purchase, hypothetical number, $10 million purchase. They do 80% cash, 20% stocks, right? But they withhold a big portion of the cash because they worry about you shrinking, you're leaving, you're not meeting your earnouts. Mm-hmm. And what are the common themes that you have seen, and how do you advise your seller to choose the best one for them? Thank you for all your support to our channel. Here is a quick word from our sponsor. Please click on the link below in the comment section to sign up for a demo with Track AI.
What if your insurance sales conversations could work harder for you? Meet Track, your AI-powered conversation intelligence partner. Track automatically captures and analyzes every customer interaction, providing instant call summaries, risk analysis, and AI-driven coaching insights. Say goodbye to manual note-taking and hello to more selling time. Track handles the admin work while you handle the revenue. Fully integrated with your favorite platforms. Plus, get custom AI analysis tailored to your unique business needs. Transform your sales team's performance with Track. Visit track.ai today.
Click the link in the description below to schedule a demo with Track today.
So our job is to go out and bring them options and to help them negotiate the best deal that's out there. And certainly more and more deals, more and more buyers are now pushing equity, more of the private equity backed buyers are pushing equity as part of a deal. From our point of view, it's let's get the best terms all around. So, ideally the cash up front is more than what we were targeting. And then the equity piece is your great icing on top of the cake. And that's usually what we're negotiating, trying to minimize the equity. There are very good firms out there. There are firms that I would not want their equity myself, because it's really just a handcuff and it's not liquid, and for a number of reasons. And so we try to steer our clients to the ones that, 5 years from now, we're comfortable saying, yeah, you did the right deal, but the bad players are the ones that go direct. So meaning most of the deals they do there's no advisor involved, because then they can sell them on, how great their stock is, but we have insight. So
Let's talk about that for a second, right? There's a lot of different players out there. There's fintech player that could be your buyer. There's private agency could be your buyer. There's, PE-backed agency could be your buyer. How do you evaluate their shares?
from our point of view, so most of the ones we're working with are the private equity-backed brokerages. And in the last 5 years, a lot of them popped up, it doubled the number of them probably in the last 5 years, which means that quite a few of them haven't even gone through a single recap yet, or they're close to it, or they just did. So there's not a whole lot. Our objective is that we want to show our client, here's the track record. So a large firm like Hub or somebody who's been around a long time, they can show you their share price over a long period of time. And then you've got much more confidence that they're going to deliver going forward. The challenge with some of the newer ones, especially if it was before they did a recap, is they had no history. And, so there's nothing that they can lean on to say, here's how we've performed, and we project we're going to perform this way in the future. It was a lot of take our word for it. This is what we expect we'll achieve. And then the interest rates went up, and that changed the whole game for a number of the ones that formed in the last 4 years or so. So to answer your question, we try to get data from the buyers to share with our clients, like, what are your projections for the share price in the future? What is that based on? What data do you have, from previous recaps and share prices and everything? And so we're trying to get information to share to our clients, but everybody has to understand that they're privately held. They're not liquid typically until there's a recap. And, you want to understand, like, where do you fall in the waterfall of equity? If there is a liquidation event, like, are you going to be able to liquidate your shares, or are you going to have to hold them, which some of the firms are not allowing shareholders to exit. And that basically makes it golden handcuffs.
I think you just get
Wow.
a little nerdy about too, like the way valuations, kind of a scale, if you want to say. So there's like a small private independent company. There's private equity companies, which are still private companies. And then at certain scale, you can take that company public. And so even though there is a difference in the management, the governance of those companies, maybe some of the regulations as to how they're handled with investors or shareholders, just like Mike said, it's still a private company. And so there isn't necessarily a secondary market that you can buy or sell your shares to get out very easily or liquid, compared to, say, buying a publicly traded broker stock on Fidelity or some other platform, right? You can just click buy or sell and get in and out. And so it still is going to be based on the governance, right? The management structure of that company, probably the transparency of the financials. There's a lot of things that go into that you can help make an informed decision. But just like your own agency that you're running, it's a private company, and you got to trust somebody else with the stewardship of that equity. And not every company is run the same. Doesn't matter how big it is.
We move on, we sell, we made a great choice. And then now I have this 20 or 30, depends on where I am, right? 30% plus liability taxes. What do you guys come in an advising role there?
There are there are tax strategies that can be implemented based on certain scenarios, meaning what is the legal structure, what state are you in? But in a lot of cases, there's no real strategy. Like there's nothing that can really be done. If you're in a low capital gains tax state and you're an S corp or something like that, there's not a lot that you can do to get around it. The times that we've found success is like if the client's a C corp, then we might be able to structure it in a way that mitigates the second level of tax or something like that. But from a tax point of view, I mean, for the most part, you got to pay the IRS. You can't, there are some ways to minimize it, but if you're paying 20%, then historically speaking, that's not a bad tax rate to be in. Nobody likes to pay any taxes. I don't like to pay taxes, but it just comes with the nature of making money.
And I'll call back to one of your earlier questions. You asked, like, say you're 2 years out, you're trying to plan. That would be some of the questions that we ask. What is your total financial plan? Do you have other assets, right? Do you have other investments that are going to support your retirement? Or do you have all your eggs in one basket? And so, your personal financial plan is going to come into play as to when it might be the right time to exit or sell your agency based on, your other resources that are available to you for your lifestyle, right? Or your stage in life. And so if the taxes would be a burden, that would be a legitimate question to help with your planning. Or do you have other sources of income that you may not have to rely on that as much, right? So even though we don't do the personal financial planning side, those are important questions that would come up as part of that process.
Yeah, we'll do a tax estimation for them based on their state and what we expect. One of the questions I'm answering a question you didn't ask because it's one that clients ask, like what can I take the payment over time to mitigate some of the taxes? And because there's a thought if you do like an installment sale, then you keep your income below a certain threshold, which keeps your tax rate lower. My opinion on that is there's a huge risk of taking money out over time for somebody to pay you back. You're losing the ability to invest the money. I think the risk and the lost opportunity to do something else with the money outweighs the tax benefits. So I'm usually against, trying to set up some kind of clever installment sale to mitigate taxes.
Isn't that also the proverbial question if you win the lottery? Do you take the annuity or do you take all the lump sum cash up today, right? No different.
Yeah.
Do you want to set up a 10% installment interest?
Yeah.
So now let's just say I'm a younger founder and I want to get out and I want to go back in as soon as possible to go build again. What are the scenarios do you have seen that seller have agreed to things like that? They put zero compete and no earnouts.
The large national brokers are going to have standard non-compete terms. So you're going to have a 5-year non-compete. It's actually going to be the greater of 5 years from the sale or 2 years after you leave employment of the company. That's how you're going to get the highest valuation. You can go sell to a private agency at a much lower multiple probably, and negotiate no non-compete or a much shorter non-compete. But if you want to maximize the value on the sale, selling to one of these national firms, you have to play the game that they play, which is they want the maximum non-compete term, which is usually 5 years. And a lot of the national firms will have a national geographic stretch or, within so many miles of any one of their offices. So they're going to try and lock you out of the game for, as long as they can once they go through that acquisition.
It does happen also. So I even worked on some deals myself where owner sold to a larger agency, after a certain period, they got their earnout or some other differences, they ended up leaving, waited their 2 years, and then start up another agency right in their backyard, and are successful because they've got the experience, they've got probably the reputation and the network. It's risky to say that, but I think a lot of people have the perspective that if they've done it once, they can probably do it again. And so, it can't be done legally, right? As long as you follow the rules of the game, but it does happen. Yes.
And I'm pretty sure that's how Baldwin Risk got formed. I don't think they're going to be listening, but the Baldwin family, I think, sold an agency, waited out their non-compete, started over, and built a massive firm.
So I've got another one. Won't go into too much detail, but it was a family agency. They still owned the building that they sold to the bigger agency. And then after they left and after the non-compete ended, one of their pride and joys was kicking the buyer out of their building so that they can take it back over and start their agency again. So, there's different ways to start over again, but yeah, that it does happen.
That's funny. Coming up on 2025, we're at Q4. How was your year? what did you guys end the year look like?
We have, I think 20 transactions we got 20 transactions we're working on. Of those, I think we got maybe 12 or so that are going to close before year end. So it's going to be busy. It's last year was slower. Story I tell is, Q4 2022 is when the interest rate shot up, and then all of a sudden we saw everybody pumping their brakes for probably 6 months or so. So last year across the board, it was like a 25% drop in M&A activity. I think this year's going to be somewhere between last year and the peak of 2021. The year will end up being pretty strong, I think, because we also have an election year, and so that's driving people to make changes too.
It does.
Yeah.
If you compare the last 5 years in MA in the insurance agency between activities, frequencies, and valuation multiples, which year was the craziest year the last 5 years?
2021.
2021.
Yeah.
And which year?
Interest rates dropped after COVID, and it just lit a fire to everything.
And which year was the lowest?
Last year, of the last 5 years, last year was.
And if you have to make a bold prediction for 2025, what would you say? What would that look like?
Somewhere in the middle. It's going to be better. The interest rate drives a lot of what's happening, and yes, some of the stuff that's happening in the carrier markets affects M&A, but it's really the interest rate that makes it. So when you have significant swings in rate, that's when you see significant changes in activity.
Colby, anything you want to add to that 2025 prediction? Any trend that's coming?
I'm going to agree with Mike, but I'll add a little bit to that. Is usually, I think private equity buyers or larger buyers have access to their own probably preferred facilities or capital. And so when you see the interest rate fluctuations, that opens up the avenue a little bit more to, say, smaller or private buyers, because the availability of that cash is a little bit different. And so there are some data that shows or tries to segment, PE buyers versus private buyers versus public. And in my opinion, that's probably more the difference in the years, like Mike said, to the interest rates, as who has the ability to compete on those deals at any given time based on, the cost of money.
Yeah. Yeah, I think Gallagher picked up activity last year when everybody else slowed down because they had a war chest of cash.
Who do you see today that have a war chest of cash?
I mean, we're seeing, last year we saw a couple of the really active acquirers kind of sit on the bench when they got squeezed with the rates. This year it seems like everybody came back to market, and so again, the multiples are pretty consistent with the last couple of years. The main change is the equity component, where so they may come in with an offer 10 to 12 times EBITDA, but whereas before it was, let's say, all cash at closing, now it's like 80-90% cash and then equity on the other part of it. Some of them are pushing 30% equity in their deal, but that's in my opinion because they can't afford to put more cash up.
I have a question I wanted to ask earlier and I forgot to ask. How would you say, as far as the scale of growth of agency going to the valuation, if we are not a big agency, but we're very, very aggressive and we have a really, really good track record of growing our revenues, how much does that put into your valuation perspective?
So like an agency that's got a system where they're driving double-digit growth, something like that. You think of a valuation as part based on the future. You look at the history, that kind of drives part of it, but really acquirers are buying for the future. So if you have a higher growth rate, that definitely impacts the multiple. There's other components to it, but I mean, it could be 10%, 20% higher multiple, whatever. I mean, part of it's going to be that they're going to, you're going to have the earnout as part of the deal, in which if you have this growth engine, then everybody wins on the back end of the deal when you're able to drive more growth and maximize your earnout. But it usually does drive a higher multiple, but there's a lot of other factors that figure out how much higher.
The two components of the valuation also are going to be the cash flow and the risk to that cash flow. So if the cash flow is stable, but there's high risk and there's a chance that it could be impacted in the future, then that's going to drive a lower multiple. But if you've got good cash flow and lower risk, say like less owner dependence on that cash flow or that production, then that's going to lead to a higher multiple because the buyer would have more confidence in the future income potential of that agency. And so Directly valuation formulas, there can be growth factors. So every 0.5%, 1% of growth can be a leverage point to, the potential future value of the company.
When we talk about earnouts, what percentage of deals are you seeing these days that's uncapped earnout versus capped?
Yeah. I think they're all capped now. Some of them got burned.
But if they got a bunch of growth acquired out of it, why would they be burned? Right? If they're acquiring earnouts at 7 times EBITDA at 110% base, they cannot be burned, can they? Theoretically, they're just buying more business at a cheaper multiple.
Yes. Colby, you go ahead, chime in.
A good financial model should incorporate future risk. And so if you don't really think that certain types of growth are a possibility, sorry, not possible, they are possible, just might be improbable or very low possibility, then the financial model may not account for that. But as Mike said, I think more buyers are seeing potential upside risk that they may not have thought of before. So it's no longer just an incentive to try to get people into the pipeline and join your organization. It's more of a deliberate compensation planning tool. So it's similar to like a producer comp plan, right? At an agency, if you give them commission rates that are high or aggressive and don't really plan for their growth long term, it could have downstream impacts you don't think of. But deliberately designing the plan to achieve both goals or mutual benefit for both parties, you're seeing more people do that.
This episode going to turn into Jeff's question episode, but I hope I'm asking the right questions our audience can relate to, right? So if you think about selling your agency, make sure you appreciate this episode and go follow Mike and Colby on LinkedIn. And I am going to put all their links in the comment section. I'm going to go ahead and send you guys an intake form. But go back to Jeff's question. So have you seen like scenario where two people bidding for a same seller's book? And they're adding, so for example, one is a new PE firm trying to build up their insurance role model. They're now offering VP roles, C-suite roles to a potential agent they are buying, they're acquiring to bring more insurance expertise onto a bunch of young PE players. And then vice versa, do you see more existing established big national brokers say, you know what, we got a bunch of old guys retiring because 500,000 insurance people retiring. And then now we want you to take over this VP role or this president role. Like, how would you navigate that for your seller as a consultant?
Yeah. So everybody is in need of good people, and small agencies, big agencies, everybody. There's a shortage in the industry. So certainly, our clients who generally have decades of experience and all that wisdom of the industry and managing people bring a lot of value to the deal themselves. Every one of our clients has different objectives, in terms of what they want to do after the sale. It's a lot of time, like we've got one right now, the guy's great producer, late 40s, and he doesn't like managing the office, doesn't like dealing with all that stuff. He just wants to go back to selling. So, in his case, his ideal outcome is sell the agency, get a great payment, take some stock in the buyer, and then just let me go produce and let somebody else manage the day-to-day stuff. So it really depends on what our clients want to do. Probably half of our clients are ultimately doing it because they want to retire in the next, couple of years. So for them, they're not looking for a career move, but we've had plenty that are in their 30s and 40s. Jason Butts was a client. He's a great guy. He now runs IOA's personal lines. Really smart guy. He just decided for personal reasons to sell the agency, but he's still in it, and it was a great acquisition himself for IOA to bring somebody on with his talent and skills.
Just want to say shout out to Jason Butts, who was on this podcast a couple days ago, talking about Hurricane Helene. So fantastic guy, and I'm going to run into him at InsurTech ITC Vegas. So are you guys going to be there?
No, we're going to be there the week after for an M&A conference. We're missing ITC.
Hopefully next time.
Yeah, I know. We do need to get out there.
Yeah. So anything else coming up for the organization? Any growth in the horizon for your organization, Mike?
Well, like I said, we're putting together some new services, so we're getting those rolled out here in the next couple months, and we're going to keep growing our team. Colby was a great addition, and we hope to find more smart people like him that are great bring a lot of knowledge and skills to the team. So we're always looking to grow.
That's awesome. I'm looking forward to having you guys come back on a couple more podcasts, and there's just so much more we can talk about. But I just want to say thank you for coming onto the podcast today, and we're looking forward to the next one.
Yeah, and I appreciate all the posts you make on LinkedIn too. I follow all that stuff. It's great information.
Yeah, I try to bring a little bit different perspective from different part of the world. So
Yeah, well, thanks for that.
So I'll say thanks for the design tips. Maybe next time we join the show, I'll have my new office and be similar design almost yours. So
that'll be awesome. Well, thank you for tuning into this episode, and have a good one.